Hello, hello. Welcome to Grandma's Wealth Wisdom on a YouTube Live, Facebook Live, wherever you're joining us from. Thanks for being here. We've got something really exciting to share with you today. It's going to be a little bit of an experiment today, but we're going to show you how to take a 4% rate of return and make it into a 17.5% rate of return. And then we're going to show you how to take a 12% rate of return, 22 rate of return, kind of. It's going to be a very much a fun experiment kind of day. So be sure that you tune in and pay close attention because we're going to be doing a little bit of a deep dive here. Brandon, did you bring your scuba gear today?
I forgot it.
No snorkel for you?
Nope, not yet. That's in December.
Okay. Sounds good. So if you're joining us for the replay, hit that thumbs up button. Let us know that you like what you're hearing. If you're catching us live, be sure to use the comments and to ask questions, share feedback. We're going to go maybe fast here. And so I want to hear from people, anything you have along the way. This is meant to be interactive. That's why we do it live, so that we can have interaction. Brandon, any other housekeeping things? Sorry, go ahead.
Well, this one, again, we have been doing these live, getting better at them all the time. This time we have some, not just Amanda and I talking, but we got some numbers to show. There's a lot of things and notes to take. So write those things down. There's lots of notes. We're going to use that. And if you like this video, don't forget to hit that like button, hit the subscribe button, tell all your friends, whatever, I don't know. And the key for any of this is, how does this apply to you? And don't just listen to a video, but figure out how to implement these principles, these things, to better your financial future. That's why we create the content, why we do what we do. And otherwise, it's just another video on YouTube or on Facebook that you don't do anything with. So learn, see if it works for you, and implement.
Yeah. And then also, we're going to make some references today to a concept called velocity banking. If you're new to that concept or you want to hear our take on it, I just shared a link in the comments with the background info and a link to our podcast episode from last Friday. So you can check out what we shared there about velocity banking, what it is, how it works, and some pros and cons to consider as you think about whether velocity banking would work for you. Okay, so without further ado, I'm going to start sharing my screen. And you're going to start to see some real numbers and some fun things happening. So I created, and I'm not going to be able to see comments while we're doing this, Brandon. So please don't interrupt me and let me know if there's any comments as people have questions, concerns, thoughts, ideas. Okay. So
well,
created
and
this
I do want to have one interruption so far.
Okay,
is we do have some videos and podcasts talking about velocity banking. This is kind of like building on from other previous episodes and a Q&A call that we were on. So anyway, just a little plug to our previous episodes and the episodes coming out.
Yeah. Okay. So we're going to talk about some fun with math. And there's no promises of links to reality here. Today is meant to be an exercise of the imagination that can help you maybe see reality more clearly for yourself. So take what sounds like something you want to dive deeper into and explore more, and go explore more about it. This is meant to just be some imaginative exploration. Okay.
In some reality, I mean, I'm hoping it becomes, some of it's realized.
Yeah, I'm going to use some real formulas and math here. Like math, I'm not changing how math works, right? So,
Yep, there you go. There you go.
yeah, there we go. So to help emphasize that this is an imaginative exploration here, we're going to be talking about Fred and Wilma Flintstone. And this is really big. I haven't used Jamboard very much, so I got to figure out how do I make this smaller. Normal. There
Jamboard.
we Yeah, it's a Google thing, I think.
There you go.
I
Hey,
heard about it, thought I should look into it more. Okay, so Fred and Wilma Flintstone. We're going to be catching up to them when they're 56 and 53 years old back in the Stone Age. And they are going to be active real estate investors who own a bunch of different properties, have been working in real estate for several years, maybe a couple decades. What was the name of their town? Like something like Stone Age
I don't know.
Park or something like that?
I don't know, but I was thinking of some good condo names: Stone Lake, Stone.
Yeah, I'm sure
Who
everything's
knows?
called stone, yeah.
Yeah.
And they just sold a property, and they have kind of their emergency savings, so they have a considerable amount just hanging out in, like, a savings account. Not really doing much, they're in a low interest rate environment, similar to how we are, so they're not expecting much growth, it's waiting there, trying to waiting till it can be deployed. And they're trying to figure out how do we do this the best possible. And of course, they have their own home too, where they live. They have a mortgage of $550,000. And it's a low interest rate environment. So it's 2.875%. And the property is valued at um, let's see, property value equals 687,500. This $550,000 mortgage is 80% of their property value, so they don't have to do any kind of PMI insurance or anything like that.
This dream
And
world seems somewhat like some people's reality.
yeah, it may be. So Wilma has come to us, come to Grandma's Wealth Wisdom, trying to decide if what to do with her half of the 380. Um, so with her 190,000, because they're taking this 380, they're going to do it 50-50, Fred and Wilma's trying to figure out what she's going to do at that $190,000. Okay, she knows for sure she wants about 150,000 of that to go into real estate syndications. So that's part of why they sold their last property. They're done being landlords. They do not want to be landlords anymore. And instead, to put it into syndication, have someone else be the landlord, and they just get to keep the money, right, that's made from that effort. And her estimate is that she'll make about $1,000 per month of cash flow. And this one happens to be a long-term hold in the syndication for quite a while. It's not one of those that's going to revolve quickly, where they buy a big, unit multifamily and then sell it 3 years later. This is one that's going to be a long-term hold. Okay.
Gotcha.
Any questions about Fred and Wilma so far?
I'm just trying to think of good names for the hold and who's going to get it. Stuff.
Okay. So that's Fred and Wilma. I'm going to move this up here, kind of out of the way. Maybe I can move. Can I move this now? Move this over here. Remember, we're in Fun with Math land. Okay. Now I want to introduce you to a formula that I learned in a textbook. Actually, it's a textbook that was given to me to help me prepare for the Certified Financial Planner designation, to be able to sit for that exam. I've been studying this textbook and learning a lot of things. Actually, I'm on my third textbook of 7. And this was, before I tell you this formula, I have to say you got to use it with caution. I was actually kind of angry when I learned this formula. Um, and it's going to show you how people can manipulate and play with this idea of rate of return. Okay. I
Gotcha.
think so. This is what we're trying going to play around with is this idea, and I'm giving you some background information, and then we're going to see how this applies to Fred and Wilma. Okay.
I mean, everybody talks about rate of return, so I think it's good to
Right.
explore.
And there's average rate of return, internal rate of return. There's different ways to factor up rate of return. And this formula is going to be for the holding period return. Okay. HPR, holding period return. And that's
Okay.
going to equal the ending value of the investment. Okay. Actually, I should probably put a parentheses here. Minus the beginning value so that you're getting, here's what your actual like return was. And then you're going to subtract any interest paid. You're going to add any cash flow that comes in, right? So you get an even, here's what you started with, here's what you ended with, here's how much interest you might have paid if you took any kind of loans to do this, here's how much cash flow like dividends or real estate income that you got. And then you divide that by the initial investment. Okay? Pretty simple
Gotcha.
formula, nothing too major. Ending value minus beginning value minus any interest paid out plus any cash flow divided by initial investment. So here's what happens. If I take Fred and Wilma Flintstone here and I take their current home, not really an investment, right? It's just the place that they're living. And let's say they had $687,000. They could just have purchased their home outright, right? Instead of taking a mortgage, they could have just paid cash for their whole home. If they did that, so if they paid 100% of their property value and didn't take a mortgage, then their initial investment would be 687,000. Their
Yep.
beginning value would have been 687,000. Their ending value, let's just say they get a 3% uh, growth of their equity in their home, like their property value grows by 3% every year. So no down years, no years above the 3%, but they get a 3% growth of their home's equity every year. Okay.
Okay.
Then they end up there after 30 years, their ending value ends up being over 1.6 million. That's really great, right? So we put 1.6 million in their ending value. We put 687,500 in their beginning value. They didn't pay any interest because they didn't have any mortgage. They didn't have any cash flow because it wasn't an investment property. It was just where they're living. And then we divide by their initial investment, 687,500. They end up with a holding period return. Holding period return is 143%, which is like 4.76 per year if you divide that by 30 years. On the other hand, if they paid only 20%, right, of their property value
Mm-hmm.
and used a mortgage like they are right now for the other 80%, and if they still get the same growth, then their holding period return is, wait for it. So we're doing ending value is the same, 1.6 million plus. Their beginning value is still the same, 687,500. They did have to pay interest on that mortgage. It ends up being about $271,000 of interest. There's still no cash flow. It's still just the home they're living in. And then divide by the initial investment. The initial investment isn't 687,500. their initial investment is only 20%, 137,500. So because that denominator, I guess is what it's called on the bottom of a division equation, is much lower, then their holding period return is higher, 516%, which divide by 30 years is 17.21%. So what this is showing is that if Fred and Wilma Flintstone used a mortgage, they get a higher holding period return than if they don't use a mortgage, because they get all the equity either way. It's just their initial investment is lower. They still end up 30 years from now with a home worth 1.6 million.
What do you think Dave Ramsey would say about this?
Right, I know, right?
Or he would tell you, why are you pulling out the fancy calculators? Don't pull out the fancy calculators, you idiot.
Right. Well, again, we're just having fun with math. You could actually add in here, instead of interest paid, you could add all the repairs to the home they needed to make, all of the, the maintenance costs, all the things, and they might end up with a negative holding period return when you factor in property taxes and homeowners insurance and all the costs that go into owning a home. We're just keeping it really simple here. But people use these formulas with the stock market all the time. Do you know that?
I didn't know that.
Yeah.
I mean, you're learning about all this stuff, so
So
maybe I did know a little bit, but
you're probably aware, Brandon, that people buy stocks with borrowed money.
Yeah, I've heard that.
Yeah. A lot of times when you open a brokerage account, you also get a margin account with that same brokerage, and you can use the brokerage's funds to buy more stocks. You're not really buying them, but you're kind of buying them. But anyway, you can borrow money and be able to buy stocks. It's just if the stocks go down in value, you can have a margin call, and it gets into all kinds of craziness. But you can imagine if you took the ending value of your stock, the beginning value of your stock, right? $20 minus $10. The interest you paid on that loan from the brokerage might only be $1, right? You might have gotten some dividends in there if you got a dividend paying stock, and then you divide by your initial investment, which might have been $5 because 50% of it was borrowed money, right, on the margin. And so you use that same thing. That's very commonly accepted in the stock market to figure out your holding period return. And if you hold a stock for 30 years, right, it could be in these high amounts, right, just depending on what happens, right?
Yeah.
Holding period return formula really shows if you are leveraging other people's money, you get a bigger holding period return, everything else being equal, as long as interest rates stay low.
Gotcha.
Okay.
I mean, again, you're just doing math, so
yeah.
This is interesting. I mean, to see.
Yeah. I'd be curious if people have heard of this whole idea of holding period return or not, or if it's something new for you. It doesn't have a lot of options in terms of, I'll make it a fun color. There we go. So remember this holding period formula here. I'm going to delete this, and we're going to talk a little bit about the next acquisition that they would make. Okay. What would happen there? Now, so I'm going to delete that. I'm going to leave this Jamboard for a second. And let's see, stop sharing. Got to share a new document with you. And we got to go over another basic financial concept that is very much used in velocity banking. Finally, I'm going to talk about velocity banking, although that holding period return and what we just did there might tell you something if you've looked at velocity banking before in terms of where some of that stuff comes from. Okay.
Well, I want to jump in here real quick and say, if you're listening to this or you're here live, put some comments in there. Would love to know. I see we have a few people watching. Would love to know that you're here. What about this make sense or not, put some thumbs up and likes or something, just so we know we're not like talking to ourselves. I know we're not, because I see a couple people online. So
Yeah. Let me know if I need to go back over anything, or
yeah,
how you feel about this whole manipulating the return, right? If you saw 500%, but because Fred and Wilma still end up with 1.6 million at the end of the day. It's just the
yep,
percent that they're shown that here's how much money you made is different. Okay. So another basic concept is the difference between a mortgage and a HELOC and how interest is calculated. So here's Fred and Wilma's mortgage, 550,000. This is actually 2.875. It's just rounded up a little bit. And if they pay a 30-year mortgage, they put their $2,000 in every month on schedule. Like maybe it doesn't matter when during the month they pay, they're going to pay the same amount of interest over those 30 years. If
gotcha.
instead they're able to get what's called a first position HELOC, and they're maybe able to get 80% of their value as a home equity line of credit, then the interest is calculated a little differently. It's calculated daily. So I just for fun created this little Heloc calculator. This is Amanda created, not created by a bank or anything. It's not a computer algorithm. It's just a spreadsheet. And I put in the 2.875 and then divide by 365 days a year. Part of what I did not factor in is leap years. That would have just been a little too complicated. So it's not perfect.
What? You're not perfect?
No, not perfect. And then each day, the interest is calculated. And then at the end of the month, it's added to the HELOC, right? See here, it goes from 547 to 549, right? Because
Mhm.
that interest is added. And all I did was switch the same exact payment, but I put it on the third of the month. In the like they're actively paying their home equity line of credit early, and that's the only thing I changed. Still the
Okay.
same payment, just paying on the third of the month rather than paying anytime during the month, and the mortgage calculates it as paid on the day it's due. And I found, so this goes down. Let's see, how many lines does it go down? This goes down 10,655 lines till when their balance is zero, and when they make that final payment. And I found when I added all of that up, here's how much interest they paid. That's how many charges of interest were there. They end up saving $9,300 just by using a home equity line of credit and paying on the third of the month the same payment that they would have paid on a mortgage over those 30 years. This difference in how interest is calculated is why velocity banking works, because often, whether it's your full mortgage or a part of your mortgage, you'll replace with the HELOC and try to, you'll deposit your whole paycheck in, you'll charge your expenses later, and kind of the arbitrage there gets you ahead. But even if you just paid the same amount, you just paid it early. Now, again, I shared in the comments background info here. Be sure you listen to our last podcast episode to get some of the gotchas and things to watch out for when it comes to lines of credit and how banks use them, and
Yeah.
how they work a little differently than mortgages, other than just how the interest is calculated. So what I wanted to show you, so if you remember from the Jam board, Wilma has a lot of money that she wants to put into a real estate syndication. And she has a little bit more than that just hanging out in a savings account too. So I took same exact calculator. I just copied, the columns, moved them over. But I had Wilma being, saying, okay, I'm going to start velocity banking, and I'm going to take my portion, most of my portion. I'm going to leave about $10,000 in my savings account just to hedge my bets, make sure if my tire blows. Actually, they didn't really have, well, no, they had wheels. They were just stone. So, maybe, I don't know, a
The rubber was
dinosaur
better.
eats
Yeah.
my roof or something.
I mean,
Uh,
she's good. She wants to have at least 3 months available.
Something like that, yeah.
Yep.
So she leaves $10,000 in her savings account and puts $180,000 as a payment toward her HELOC. And then she goes and finds that syndication deal and takes $150,000 out and puts it into a syndication. And then a couple months later, the syndication starts sending her a $1,000 check in the mail. Again, these kinds of syndications may or may not exist. This is all fun with math, exercise of the imagination. So here's her 180,000 going in. I still have that same payment as before. Here, a couple months later, here's her 150,000 coming out when she found that syndication. And then a couple months later, it starts the extra $1,000 per month, still on the third. That's the only variable I changed was the amount, starting a couple months after the syndication starts. So she's got $30,000 extra that she's paid down, and she's paying $1,000 extra starting a few months later. Look at this. Her interest that she pays, she gets her mortgage done in 16 years, or the HELOC done in 16 years, a little over 16 years.
Yep.
And she cuts her interest in almost half. She only pays $131,000 instead of $130,000 on their property in Stone Age Park or whatever. Because remember, it was on the mortgage, it was $271,000. If they just use a HELOC and don't pay anything extra, it's down to $262,000. And now we've cut it in half again, just by using it rather than paying directly cash into the straight from the savings account straight to the real estate syndication, right?
Yeah. So it's not a total interest. That's that total interest charges of 131. She doesn't have zero interest after that time.
Right, because she's still, I mean, the balance went down, and then it goes back up when she takes out the 150,000, but it's still lower overall than it was before. And she ends up paying it off in about the same amount of time. Actually, sorry, it was 30 years. Now it's 16 years that she's able to pay it off in. Okay.
Yep.
So it's a lot faster too. Okay. Yep. So let's go back to, let me stop sharing this screen, and we're going to go back and we're going to tie these two things that I just shared about together. Let me go to this Jamboard again.
And we still got people. People are listening. So
yeah,
you are capturing some attention there.
Good. Quiet. I hope you like this real math in imagination land.
We got to do more of these videos. That's what it
So here's what's fun. Here's what we get to do with the holding period return. So we talk about, let's say, remember how we did with the mortgage, or I mean, with their property, their home that they lived in, we gave it a 3% equity increase every year.
Yeah.
If their regular home's doing that, then the syndication property, let's hope, does that too, right? So for ending value, I'm going to take that $150,000 that they put in, and I'll pretend like when they sell it, they get a 3% growth on it for every year that they hold it. Okay. And so they end up, whenever that property is sold, they get their equity back out from the syndication. Let's pretend that when the syndication is sold in 30 years, that then instead of being worth $150,000, it's worth $364,089. That's 3%. Okay.
Gotcha.
So that's their ending value. Their beginning value. Can you tell me what that is, Brandon?
Is it on here?
Yeah. How much did they put into the real estate syndication?
Oh, I think it was that 100 and something.
150,000.
Yeah.
Yep.
150. Yep.
Then interest paid, you could use the Heloc calculator that we were playing with, right, to calculate how much interest they paid. But wait a minute. They didn't pay any interest on the 150 because it was money they would have been using anyway from their mortgage, right? They actually cut their interest in half.
Okay.
So, And then you can add the cash flow, the $1,000 per month for 12 months for 30 years, pretending, that never changes. Maybe it goes up as rents go up, that kind of thing.
Yeah.
And then you divide that by their initial investment, which was 150,000, but it was the bank's money kind of. It was money from their home, right? That was kind of in the walls of their home, that they were using. And so it gets kind of muddy in terms of how you calculate it.
Yeah.
What is their initial investment? Is it the 150,000? Well, not exactly, because that was just in their home. They didn't actually they just kind of gave up what they could have done with that $150,000 otherwise.
Okay. It's
But
still there, kind of.
yeah. So I thought, for the benefit of the doubt, I'm going to keep 150,000 as the initial investment.
Yeah.
I'm going to keep that there, even though, like, some people might argue, actually their initial investment was 0, and you can't really divide by 0. So that's why we had to put something there. Okay. So if I take, when I did the math here, and you can do this on your own, fact check me, if they had just paid cash for that syndication, they just took that 150,000 and put it directly to the syndication without paying down the Heloc first, and then, and all
Yeah.
that kind of thing. Then their holding period return, so if paid cash, then holding period return is about 383%. 30 years, remember, which is about 12.76 if you divide by 30 there. If you want it annualized. Okay.
Gotcha.
Okay. If they use the Heloc, this velocity banking kind of strategy, right? Then their holding period return, because of the interest that they saved on their mortgage by doing putting the 180 in, taking out the 150, using that 1,000 to pay down their mortgage, that brings their holding period return, and holding period return equals 470% because of the interest that they end up saving. Now, you could look and see if they put that $1,000, like, let's say they paid cash and they put that $1,000 extra on their mortgage. Would that bring this 383 up to 470? You'll have to do the math and tell me that. But I think I teased some people when I said I was going to do this video, that there's actually a way they can do better.
What?
Yeah.
Yeah.
I mean, this all looks really good, right?
Well, and I think that one is if people understood how this works, and what these people who are watching this are probably a little smarter than the average person, because they are thinking about that, and they are maybe calculating math, maybe, and doing it in their own imagination of their own lives. And I think that, honestly, I've thought about this a lot, saying, should we be doing this? Is this better or what? And I think you're going to show us that other way.
Yeah, actually.
Is there another way?
Yeah, let's have a quick side note here about kind of the moral side of this, right? So a big part of this holding period return and using other people's money so that your initial investment is lower. And when you have a lower denominator, you're going to get a higher result, right?
Mm-hmm.
That for some people is just a no-go, because they're like, I don't care if I make 1,000% extra. I don't want any interest to go to banks, right? I think, neither a lender nor a borrower be, right? That all debt is evil. I'm not going to do this, even if it gets me a huge rate of return. And other people are going to say, well, my morals tell me I better be a good steward and get the biggest rate of return I can get, because my family depends on me getting that. And I'm going to use other people's money to be able to get that, because I know then I get all of the growth still, and I can use it to benefit my family and be a good steward of what's given me. And we're not here to judge or tell you which you should believe or not believe. We're here to have some fun with math, help you imagine things, and tell you how maybe some other people are thinking,
Right.
rather than how you're thinking. Is that
Again,
so?
I hear Dave Ramsey versus Robert Kiyosaki in there.
Yeah, a lot of that in here. And it's in each person, right, to decide what will help you sleep well at night. What will keep you awake? What's going to be heavy on your conscience? And the grandma kind of perspective is that that's okay to think about those kind of things too. You don't have to just go with what makes sense mathematically. That it's okay to bring some morals and some values into it.
If only we had morals in our money, that would be great. I think we'd be in a lot better place as a world.
Okay, that sounds good.
Anyway,
Okay. So here's the next side of this. Actually, I'd love to hear before I show this, if anybody can try to guess in the comments what you think I'm going to show you next. What is like the third alternative to paying cash or just using debt from a bank?
yeah, let me
And
hear. I know there's people here who are quiet. What is next? What are we going to talk about? Put them in the chat. Let's hear.
yeah, we kind of
We,
totally just went on a ramble about morality and ethics and values.
I mean, that's why we're doing what we are doing is because of that. So,
Mhm.
what
Mhm.
is next? If you are listening, tell me.
I'm gonna fix your whoops, I'm gonna fix your thing here.
Apostrophe.
Yep. Use some
Uh,
real grammar here. I think all these real
so,
estate investors are at a conference right now. Maybe they're not here.
yeah, there is a smart real estate coach conference right now. A lot of them are listening or there with Chris Prefontaine. Uh, check those guys out. But after you're done with that, come watch our video.
Yeah. Okay, so surprise, surprise. What's next is a really awesome thing called Bank on Yourself. And we'll see if
Or banking yourself, infinite banking. We call it grandma strategy.
yeah.
All kinds of stuff.
And we're going to share a little bit how this could potentially come into play with velocity banking as we go here. So stick around. If you're a fan of velocity banking, you're going to get to hear a little bit more here. So here's
This
Fred
is
and
like
Wilma.
2.0, velocity banking 2.0.
Yeah. Remember they have about $380,000 just hanging out in savings. Here's what would happen if they both put funds into a Bank on Yourself designed whole life insurance policy at their current ages,
Can you
kind
zoom
of
in a
how
little
it
bit
plays
there?
out over time. We're not going to go into a lot of detail here. If you want to see numbers like this for yourself, please reach out to us. We put a spreadsheet like this together for every client that we work with. So I put these numbers together. You can see Wilma puts in $180,000 right here. All I changed for this second scenario is that in the first year she just puts in $30,000. So she takes that 150 and pays cash for the real estate syndication rather than putting into the policy first. Only
Yep.
difference. Okay.
Yep. Okay.
So let me go back to that mortgage and HELOC calculator. And here, I also have her. So one of the things she can do with a properly designed whole life insurance policy is take $150,000 out, and there'll be policy loan interest. She could pay it back with that $1,000 from the syndication that it cash flows, and she'd be done with that policy loan in 20 years.
Wait, but aren't you paying interest to yourself? Isn't that a bad idea?
Right. So that's why I've got this summary over here. So walk with me. Ends up taking 19 years to pay off that that policy loan, and she ends up paying $82,000 of interest. Why would she do that?
Yeah, it's longer time and a little more interest than
Yeah.
the other way.
So look at this. Here is the one with the 150,000. Here's the one without the 150,000.
Okay.
And what her cash value is. versus how much premiums that she's paid. And in the one where she puts in the 150,000, she has 1.784 million of cash value over and above the premiums that she's paid. And in the one where she doesn't put in the 150,000, she has almost 1.5, which is a $288,000 difference. Remember, the only difference in the premiums is that 150,000, 288. So she paid $82,000 of interest, but she made $288,000 of gains in terms of her cash value compared with her premiums that she paid in.
So through this, she made about $280-something thousand more
Mm-hmm.
because of the way.
And all the money that she's going to get in the equity of the syndication as it grows.
Yeah. So
but
by
that's
adding that extra step.
Yeah, but that's only looking out 20 years. If we look out over the course of her lifetime, so these numbers here go out to age 95. They have her taking income from the policy and leaving a death benefit as well. If we go out here, so remember, this is the one with the $150,000 in. Here's the one without.
Yep.
And look at the difference in terms of her income that she can take out and the distributions that are, and the death benefit that's still left. That's a $648,000 difference. Subtract that 150, right? That's a $500,000 more that she made because she put that $150,000 into the policy and then took it out to go do the syndication.
Wow.
And then repaid herself that way. Now, would you rather make $500,000 more or reduce the interest that you pay on your mortgage or home equity line of credit by $140,000?
That's a $300,000 difference, right?
Right.
Or $350,000 difference.
So, yeah. So so this is all, again, hypothetical, all exercise of the imagination. Fred and Wilma aren't real people, right? They're characters in a cartoon show, and some of these numbers are based on some real things out there in the world. Some are, who knows if you can find a syndication deal that's actually going to work that well. Who knows if your HELOC's going to change in the future, right? It could be a higher interest rate, it could be a variable interest rate, like all the things. But what's interesting is that the biggest difference I see between paying cash, leveraging debt, and becoming your own banker with like infinite banking is how long-term you're thinking, right?
Yep.
Are you thinking about just saving interest? Well, then pay cash, right? Or, use velocity banking to try to get out of debt as quickly as you can. Those are good things, right? But if you're thinking long-term, you're thinking over the course of your lifetime, I wonder what kind of value is being lost, right? Because holding period return, thinking about your entire holding period, right? Thinking about being a good steward of your funds for your entire lifetime, as long as you have the ability to be a steward, that brings some different mentality to it, some different calculations.
Well, and I think that's our challenge when we talk to people or in general, and just our worldview, right? Our view now is microwave generation. I want fast results right now, and get that rate of return maybe, but then we look and say, did it really pan out? Did it really work? And I think that's again why we chose Grandma's Wealth Wisdom, thinking long range, thinking about beyond us, or working backwards, right? Reverse engineering, as a lot of technical people like to call it. Couldn't we reverse engineer our lives in the same way? And that's pretty much what you did, is you reverse engineered a deal that you're doing now and seeing how that plays out in the future.
Yeah.
Uh, and
Yeah.
you literally proved by doing that you have a better position, stability, and can actually probably take on more risks, more than likely too.
Right.
Um,
And if I was Wilma, I of course would have a lot more details I'd want to put into my formulas, right? A lot more scenarios I might, well, what if my syndication only pays me 500 instead of a
yeah,
thousand? What if I put in 100,000 versus 150? What it, all the kind of what ifs. You can go down a big rabbit trail there, guilty as charged. Um,
you
but
never
what's
go on rabbit trails.
Never. I had a lot of fun putting together these numbers, and I played around with a lot of different things before I said, was like, okay, I need to just wrap this up and go with what I have. Um,
Well,
but the
apparently people like it because we've have several people that have been on through the whole time.
Great. If you want more like this, please like the video, comment, say you want to see more scenarios like this. We want to hear your feedback. Let us know what you like, or what you'd like to see next time. We do have a podcast episode coming out next Friday, the 24th. It'll be a podcast episode in here on YouTube about velocity banking and infinite banking, where we'll dig a little more deeper into how they could work together. Because, for instance, Wilma could still use a first position HELOC, and she could still decide, okay, this $1,000 I'm making from my syndication, I might put a certain portion toward my HELOC and a certain portion toward my policy loan. I might also, you do a second syndication with another 150,000, or as
Yeah.
my HELOC goes down, leverage it to do another deal while I'm also still got this policy loan working for me. Or as I pay back my policy loan, I might take some money from that and some money from my HELOC and go do another deal with it. Like, that's part of why it's called infinite banking, is that
Yep.
there's infinite possibilities. And with velocity banking, it's all about how far you're moving from point A, right? How quickly you move in the direction you want to go. Which so yeah, check out next week's episode. I think everyone will really enjoy it. This is kind of velocity banking month, where we wanted to dedicate a bunch of content related to that concept,
Yep.
because a lot of people have been coming to us and asking us if they should use it or not. Again, check out last week's episode, watch next week's. But you really have to think about the short-term consequences of your actions and the long-term consequences of your actions. That's really what it comes down to it for me. All this like fun with math and being in imagination land is let's imagine. I know the long term seems like we can't imagine what's going to happen. I don't know how long I'm going to live. I don't know how the real estate market's going to do over 30 years, let alone, 10 years or 5 years. Even, I don't know how it's going to do over the next 30 days. That's okay. We don't have to know the future to kind of run some different scenarios.
Yep.
Actually, one of my favorite things is to run a best case scenario, a worst case scenario, and somewhere in the middle, and then choose what I'm going to do.
Yep.
Now, I know a lot of people aren't going to know exactly how to do the formulas and stuff, but hopefully what I shared with the holding period return formula can help you with that. Or there's all kinds of fun calculators and spreadsheets, and you can have a financial professional help you with some of that. Actually, a good one
Yeah.
should.
And thinking through that, of making those wise decisions. And most of the time, as we work with it, we say an answer is, it depends on what you want and what you want to accomplish, right? So one of my clients I was working with, he's starting to he does a lot with velocity banking, and he sent me a text and he said, so should I do my policy, or should I, what was it, get a loan from somebody? And it's 8% simple interest. I can get a loan from somebody. I'm like, you could use your policy. 5% simple is lower than 8%. So that makes sense.
And you
That
don't
was
lose
just
any
one
of the
piece of,
dividends or the
yeah,
guaranteed growth in the policy while
that's
you do it.
just on that piece alone that I was like, I would do that. But anyway, thinking through and doing your own math, that's the big deal. So, yeah. we will do another one of these. I think people love fun with math. It sounds like Sheldon Cooper.
Fun
Fun with
with
flags.
flags.
Um, yeah, maybe are you pulling out your inner Sheldon? I guess.
If only I was really like Sheldon and you were like Leonard.
Shh.
You got the
Uh,
glasses to be Leonard.
okay.
Actually, I
Well,
could be Amy. I could be Amy. That would be a huge compliment to be Amy Farrah Fowler.
okay. All right. Well, um, awesome. Well, thanks, you guys. You guys were all here. Awesome. Very quiet bunch, but thanks for liking and being a part of this video. Share it with a friend. Send us a message if you think this was nuts or whatever. Love to hear. Don't be too hard because it's just playing with math, some fun exercises, you know. So with that, keep being awesome. And you want to take us away? Tell us the slogan, Amanda.
Oh yeah, keep continue on your journey and looking for that smart, stable financial future using the tried and true wisdom of generations and generations ago. And Sari, yes, you should go back to the beginning and check it out.
Awesome. All right. Peace, guys.